one second here. To approve resolution 2014-052. Motion by Mr. Hansi, seconded by Mr. Bunky. Any questions or comments? All in favor of the motion, say aye.
Aye.
Opposed? Motion passes. Thank you very much, Josh.
Thank you.
Jeff, you like the company? You like the company that bid?
Yes, I do. Frank used to work for him.
Okay.
Well, that's a
Frank?
strict.
Good company.
Good. Thank you, Jeff. Let's go on to number C. Paying for it. 8C, consideration of receiving recommendation from Mike Bubani, David Durant Associates, to provide a bond recommendation for the appropriate means of financing the 2014 municipal improvement project. At a minimum, council will be asked to provide authorization to move forward to secure proposals. Supplemental and supporting documentation will be made available at the meeting. Mr. Bubani, welcome.
Thank you. I believe handed out today before the meeting was a letter. As part of the letter, there was a couple of exhibits. The one I'd like you to turn to, in the bottom right says preliminary cash flow. You can read the letter at your leisure. I'm basically going to talk to you about all the things that are in the letter. But again, the bottom right, it should say preliminary cash flow. It should be a landscape type exhibit. Oh, you printed it the long way. Okay, that's fine, that's fine. Very good. Is everyone there? Okay. We got some issues to talk about, but first of all, let's just kind of handle our recommendations one by one, and we'll start with the easy stuff and we'll end with the tough stuff. First of all, the easy stuff. First recommendation, whenever we issue bonds in Minnesota, cities have to borrow money to do bonds, is to identify the statutory authority that allows you to do bonds in the first place. This one's easy. You're going to assess $410,000, which is 20% or more than the total, and that 20% threshold automatically qualifies us for authority under Chapter 429. If you're bored, pull up Chapter 429 on a computer at home, and you'll see that cities have the ability to issue bonds without an election. They hold some public hearings, which we've done. And these things are called general obligation improvement bonds. Right? One of the most common type of bonds sold in Minnesota is this type of bond here. So that authority was very straightforward and easy. Okay, we've got the authority lined up. How do we size it? How much do we borrow? Okay, so in this handout, this top left-hand quadrant is basically your sources and uses. So I'm just going to go right down the list here. The construction cost you'll see is about $900 and some thousand short of the figure that Josh just shared with you. That's because you have two borrowings going on. You've got a utility-related borrowing that you're running through the state of Minnesota, their Public Facilities Authority. So what this represents is all the non-utility related costs. So that's why you see that number is less than the number that Josh quoted. You'll see the engineering there. That includes engineering that's been spent to date, as well as the engineering that you have yet to spend. The city's probably shelled out some cash for engineering bills. We will reimburse those funds with bond proceeds. Unless you choose not to, I'm going to recommend that you do. We're going to talk about cash reserves at the city in a minute, and I think it's important to maintain those as best we can. The next item is contingency. Typically, we do 10% of construction. Why? Well, as good as our engineers are at calculating quantities and so forth, there's always something that kind of creeps up. We run into more rock than we thought. We didn't quite measure the length of pipe just right. There could be any number of issues, and this contingency, which is an industry standard, it's not because it's ODMO or WHDS or any of those other engineers. We just typically, as a standard, put in 10% contingency. If you felt comfortable enough not needing that kind of cushion, we can certainly adjust that number, but I've used the standard for now. So those are your capital related costs there. So now we're gonna get into some issuance expenses. First of all, underwriter's discount. What is that? When we go to sell a bond of this size and of this term, we're not gonna be able to stroll into Rushford State Bank and place the whole thing with them. We're gonna have to go out and find some larger type investors whose interest in your bonds is to only buy them for a moment, chop them up into little pieces, and then sell them to their own customers for a profit. And so oftentimes what they do is they don't give you the full amount of the bonds. They give you something just less, and then they turn around and sell the bonds for full price or more. So it's a profit, that's what they make. So that's considered an expense right there. That number could go up or down. That's sort of a moving thing, we don't know where that is at this point. Fiscal fee, that's us, that's our firm. That's for the design, the structure, the sales process, the closing, the drafting of the official statement, assisting with the credit rating, all that sort of thing. That's a fixed fee, that's a known fee, that doesn't change, okay? Bond counsel. The city has historically used Mary Ipple at Briggs & Morgan. It's a specialized attorney firm. There's no law that says we have to use a specialized attorney firm to do the legal work on a deal such as this, but if you want to get it done successfully, I suggest that you do, and here's the reason why. We're paying this bond attorney to do two things. One, to provide an opinion that what we're doing is legal. Okay, so these investors, whoever they are, know that we followed the right protocols. But two is she will provide an opinion that says the interest that we pay to whoever the investors are, they don't have to declare that interest income for tax purposes. It's tax-free income to them. And we could have a city attorney, Terry, or someone else provide an opinion saying, hey, it's tax exempt, but some guy that knows nothing about Rushford or lives in California or something like that, he's gonna want a noted bond attorney and have that opinion in his file when the IRS knocks. Okay, so that's why we have them involved. A pay agent is a firm that this investor, this purchaser who buys your bonds and chops it up into 1 million pieces and then sells to 100 different customers. When it comes time to make a payment, you don't want to write 100 different checks, you want to write one check. So we hire the pay agent to track all that activity that can change every day. I mean, these things get traded all around, and they will track all that. So they will invoice you, you pay them, they're responsible for delivering dispersing the funds. Printing and miscellaneous costs, that's also our firm. That is associated with things like ordering county certificates, account setup, official statement crafting, things of that nature. And then the last one, and maybe if you have a pen, you want to asterisk the last one, capitalized interest. That is not an issuance expense. That is a tool. It's a tool we use to cover a payment until our revenues kick in. So our primary sources of revenue to make payments are going to be special assessments, right, and taxes. And those are collected every 6 months. So we won't see new taxes or special assessment revenue come in until about June or July of next year. But we have to make a payment before then. So what we do is, if you look at that capitalized interest number, $24,831, and go diagonally down to the right where it says account balance, you'll see the same number. That's put into a debt service fund of the city. It's there. It makes that first payment for you. Then your taxes and assessments kick in, and you make payments going forward. So it's a tool to cash flow. It's a cash flow tool. There we go. All right, so we've got a total project cost of just over $2.9 million. So what are our sources of funds? Well, we know that we are supposed to get 1.5 something million from the state of Minnesota. I understand that's what's coming in the next month or two.
4 to 6 weeks was what we were
4 to
told.
6 weeks. So because of that, you know, my concern was they were gonna take 6 months. Then we'd have to borrow that extra 1.55 million and wait for a month later, because contractors wanna get paid today, they don't wanna wait 6 months. But because it's gonna come in the next month or two, we can use the bond proceeds to make the first pay estimate or two, and by that time, your state money will be available. So we use that to reduce the bond size. And then when you take the bond proceeds and you put them into a construction fund,